The banking sector with particular focus on stress testing. Now, the Central Bank of Nigeria mentioned about 2 months ago that it will conduct another stress test for Nigeria's commercial banks to check to see how strong and sound these banks are. Well, joining me now is Mr. Cormac Butler. He's a consultant director, Jeff and O'Brien Training International. Also joining me is Group Country Director, Mr. Pascal Odibo, also of Jeff and O'Brien Training International. Thank you, gentlemen, for being here.
Thank you.
Now let's start with you, Cormac. Now you're in the country for some training for the regulators in terms of stress testing. Let's just go straight to stress testing. What is a stress test?
Well, a stress test is designed to see how healthy a bank is and if it can cope with a severe knock to the Nigerian economy. So the stress testers identify situations where the Nigerian economy could fall downhill quite rapidly, and they try to determine if banks can survive that. Across the world, they've discovered that most banks were ill-equipped to deal with severe shocks, and this is why we've had a major banking crisis. So the objective is to try and prevent that.
So what about the regulators? Because I know from time to time the regulators for the banking industry in whatever country are usually, they monitor the progress of these banks. They go from time to time to check their books, check their operations. Aren't they equipped to identify some factors that may lead, eventually to...
Well, across the world they have found that regulators are not equipped to deal with the banking crisis, and it not only applies to complex banks like the American banks, but also to simple banks. Regulators were often using the wrong type of stress tests and the wrong type of rules to ascertain whether a bank is healthy or not. And that didn't apply to small countries. Large developed countries, including America and Britain and most of Europe, used stress tests that were inappropriate, and they used rules that were inappropriate. So the new stress tests are designed to overcome those weaknesses. The problem is that sometimes regulators don't fully understand the risks associated with banks. One major risk that did emerge was that banks were able, banks were able to record huge profits at a time when they were bankrupt. So that's something that they need to address now.
Well, Pascal, let me come to you. It's been about 3 years since the last and perhaps the first stress test, at least the one that we know about from the Central Bank of Nigeria. How often should this occur? Do we need to wait for a financial burst before we have this stress tests?
No, they shouldn't. It should be an ongoing affair and should be some kind of a systematic, progressive thing as the banks, get to do more business. Now, the exposure, as the banks expose themselves to more business, you will discover, and this is a result of the fact that they will of course post profits, and that of course naturally will give them an opportunity to increase their activities. You will see them take risks that are not supposed to be taken, and this is the job of these regulators. And I do know that the Central Bank of Nigeria, the NDIC, have reasons in the past to have both what they call on and off-site examiners who go into the banks to check their books to confirm the reports that they send to them. Okay, so it's something that should be ongoing. But the key thing, and I think what Cormac is saying here, is that what are the parameters they're using to do this tests themselves?
Back to that question, the last time we had it was 2009. Is there, because like you said, there are also monitors from CBN or the regulator who go to check their books, which we could say is another form of stress testing. But for the major ones, how often should it occur? Every 2 years? Is there like a set rule? Or it's just when the regulator feels like that, it's just wake up one morning?
Cormac, what do you think?
Well, maybe Cormac, you can answer that question for us.
There's two aspects to checking a bank's books. One is stress testing, and the other is complying with what are known as the Basel II rules and the Basel III rules. These rules are designed to make sure that banks have enough shareholders' funds to absorb losses, and banks are required to make returns at least once a year on that area. So that's done quite periodically. As well as that, within banks, they are required to stress test internally their models. So that all is done periodically. Stress testing itself, the ones that the central bank are going to embark on, they're done less periodically, and they're done in maybe once every 2 or 3 years, but it probably could be done more. But the point is that there are plenty of tests ongoing on a regular basis, so stress testing is just part of the overall framework.
Are the banks usually informed beforehand, or it's just meant to take
yes,
them unaware?
Yeah,
So
no. The banks, for the stress testing test, the banks are informed beforehand, and they supply the information, and then regulators come in and make sure that the information is accurate.
Well, if the banks are ready, if they are aware of this stress test, isn't it possible for some of them to cook their books, make it all
well, that's a separate
nice
that's a separate form of testing that is usually done by the accountancy firms. So the accountancy firms make sure that the books are proper and in order, and what the regulators do then is they use the information, sometimes the information that the accountants prepare, and then they check the validity of that information, and then determine whether the banks have enough capital. But generally it's the accountants who go in and check the books to make sure all is in order.
But it's the banks that hire these audit firms, these external audit
well,
firms?
Well, there is a problem with the audit firms, and one is that conflict of interest where the auditor might do whatever justifies his fee. There's a second problem, and that is that the accounting standards themselves have made it easier for banks to legitimately hide losses. And this has been a problem that they've discovered all over the world, not just here in Nigeria. So that's an area that needs to be strengthened, because while these accounting standards are in place, there is the risk that banks will say it's legitimate to hide losses from the regulator. So that's an area that certainly regulators are pushing to change, because from 2005 to 2009, many regulators didn't realise that banks were legitimately hiding losses. They thought it was a criminal offence to do that, but under the accounting standards as they currently are, banks can conceal losses on difficult loans, and that's where the major risk is occurring.
Now, Pascal, for our own regulator here, the Central Bank of Nigeria, let's talk about their capacity to monitor, not even for a major stress test, and then coming to the stress test. How strong are they in terms of capacity? I know that they do hire consultants such as yourself to come in to train them and all of that. But what have you seen so far?
Well, the structures on ground, you have in the central bank, there is the banking supervision, and there is the financial policy and regulation directorates, departments in the directorate, and their job clearly is to set up policies, and the other ones is to examine the banks. Now, the capacities within the banks, within central bank, of course, will be sufficient for the challenge they face at every moment. But you're dealing with a very dynamic and upwardly mobile industry. The banks and the operators are very skilled people. They have the money to buy the best hands. So they are always a mile ahead of the regulators. So it is the challenge to the regulators to, on a regular and a consistent level, seek capacity, seek increase in capacity to be able to set the agenda and set an agenda for the banks. If not, the banks will set the agenda for you, and you become very reactionary. And so one of the things we do is this capacity building around Africa, and it's not only in Nigeria, across central banks across Africa. It's not only here. In fact, Nigeria is doing pretty good. There are certain places you go and you'll be shocked at the level of capacity, and the thing is that they are not at one place. They are moving. It's a moving target. What one used to, just as you said, high losses last year, could no longer work this year, and unfortunately, some of the accounting infrastructures do assist them to high losses. And what we teach the regulators is for you to question the numbers behind the figures.
Well, while the regulators have experts such as yourself, trainers to help them with this, we often hear that the banks, the operators themselves, are usually 1 or 2 steps ahead of the regulators.
Yeah.
They put some stops, they just find a way around it, and then sometimes we're back at square one. Do you help the regulators in that aspect? This
is why. This is the reason, and it's saying it here. If you go look at the books presented by, say, one of the big 4 accounting firms for a bank, they will present it based on accounting standards, based on IFRS, using Basel II and all that. And what we're saying here, as we teach them, is that how were the figures gotten? How did you arrive at the figures? Can you question the figures? And if you don't question the figures, you will, whatever thing you're doing, whether you're stress testing or you're doing Basel II or you're any kind of risk infrastructure you're putting in place, will continually be contingent on the figure you have. But if you can go beyond the figure and say, how did you arrive at these figures? And those are the kind of skills we believe regulators should have. Can you be able to question figures that are presented to you, even when it has been passed by the accounting firms as correct? Because some of the challenges we face abroad are things that bother on using regulation to hide losses, right? But here, sometimes what you're dealing with is bad behavior.
On the part of
operators.
Now, you mentioned that the International Financial Reporting Standards, as banks have had to adopt that here. Of course, that requires full disclosure. The CBN and the NDIC can come in and look at the books of these banks. How have our banks been coping with that?
Now, this is one reason why we're doing a couple of training for the regulators. COMAC has quite a strong opinion about the IFRS, the Basel II.
I understand the Basel II. There were some deficiencies in the Basel II. That's why we went on to the Basel III.
The problem with the International Financial Reporting Standards is that, as I mentioned earlier, they have made it easier for banks to hide losses. And that means that the regulators can no longer rely 100% on the IFRS produced figures or the annual report. So therefore they need to delve into the information themselves and understand how banks price loans. And what we have had in Europe and America are situations where bankrupt banks have recorded profits and traders have received bonuses for entering into loss-making transactions. So regulators need to see that. Prior to 2005, that was more difficult to do because it was harder to hide losses, but it's unfortunately a lot easier to hide losses. So regulators need to be aware of the weaknesses of the IFRS rules and the Basel rules, and more importantly, they need to focus on instances where bankers are paying bonuses to traders who enter into loss-making transactions.
Now, we've had the Basel I, Basel II, now we have the Basel III. With all the Basel models, how sure are we that this time the Basel III is strong enough to plug all those leakages and ensure that banks, at every point in time, are on the straight and narrow path?
Well, I suppose regulators are learning from past mistakes, and the Basel III rules are designed to capture the mistakes that were made earlier. They do need to go further, though. We do need a clear indication from the accounting standards boards on how they're going to deal with losses. They've come up with proposals, but we do need to see what they're going to do. And before that happens, we can't really form a judgment on whether Basel III is going to work or not.
Oh, so we're just going with it for now, seeing how it,
well,
how it
fits? Regulators are now aware that banks are free to not reveal all losses under IFRS, so they're more streetwise as to what's going on, but there's still an awful lot more work to be done.
No, there certainly is. Hold your thoughts for us, gentlemen. Let's take a quick break. As we come back and we'll take a quick break at this point, and we'll be right back. I've been talking to Mr. Cormac Butler. He's a consultant director, Jeff and O'Brien Training International. I've also been speaking to the group country director, Jeff Pascal Odibo, also of Jeff and O'Brien Training International. We'll be looking at stress testing and the general health of Nigerian banks. We'll be back in a moment. To Business Morning. We're still looking at stress testing for banks, and I see I have my guest, Cormac Butler, the consultant director, Jeff and O'Brien Training International, and Pascal Odibo, the group country director, also of Jeff and O'Brien Training International. Now, gentlemen, during the break we were talking about some of the downsides to the stress testing, and we're talking about non-performing loans. Now, what is the current exposure, level of exposure of non-performing loans that banks are supposed to have?
But AMCON gave them 5%, which is supposed to be international acceptable standard, 5%. But before the resolution, which is before the AMCON bought off the non-performing loans from the banks some of the banks were even healthy. They just took on some portfolios.
Yeah, they were healthy, but across the board, all of them
hard, heavy. And they took off also transactions they felt was quite inimical to the health of the bank. If for any reason those things went bad, a Diamond Bank had, and those things took an impairment on the balance sheet at the end of the day. First Bank had, so certain transactions were taken out. Like geometric transaction in Diamond Bank was taken out, and the C-Wolf in the First Bank was taken out. That of course took a hit, made them have a haircut. But the point I'm making here is that the banks must begin to work within those kind of framework, and not to overstretch themselves. And because if the moment you do this test and you step out, they begin to grow again. And if they grow again, they grow their loan books based on what I said, falsified profits, you're going to begin to see this percentage increase again. So this is what really creates the cycle of bubble and bust, and there is absolute need for regulators to have a handle on it, and on a regular and consistent basis have the skills to be able to investigate the banks on a regular basis and assist them not to be able to exceed such those. Remember, I was AMCON that was telling some of the banks that banks should be telling them that, listen, you can't handle some of these transactions. You've exceeded your single obligor limits. And these are the things that if they go back tomorrow, these banks will begin to head southward.
Okay, so if a bank has taken up a loan and at some point, while it's being serviced, they just feel that this loan is perhaps too much for us to do.
Even when it's performing, if it does go bad, then it will definitely materially affect the bank. Then I think AMCON took them on, and they took a haircut on it.
Interesting. Yeah. Now, Mr. Cormac, let me come to you. Cormac, how much regulation is needed? Because sometimes the banks or the operators complain that the regulators are just too overbearing. Just give us some space. Let's do our business. And let me use J.P. Morgan Chase as an example. Now, this was one of the banks that survived the 2008, to a large extent, 2008 financial crisis. Now, just out of the blues, $2 billion lost. And of course, that has brought about that argument by the U.S. SEC that we think we need to tighten that news around it. What are your thoughts on that?
Well, there is a problem with too much regulation, and that is that if you have too much regulation, it's often hard to implement in practice. And very often, regulation which is poorly designed doesn't achieve its objectives. So you end up with huge bureaucratic organisations complying with regulation which is not very effective. So it's not that we need more regulation, but we do need better regulation. And unfortunately, the mistakes that J.P. Morgan has made, from what we know of them, they have been repeated before. There are plenty of instances of American banks buying complicated structured products and losing a fortune on them. And one I suppose, advantage you have here in Nigeria is that the regulators has clamped down on that type of activity. So if you can simplify banks and you can improve the regulation so that it's more effective, then you don't need lots of it. The big issue with the regulation is the corporate governance, and that means that if you're a banking director, you'll often act against the interest of your customers and against the interest of your shareholders. So if you can find regulation that makes you more focused on the needs of your shareholders and less on the needs of your bonuses, in other words, align bonuses to profits, to genuine profits, then the errors of J.P. Morgan are reduced or perhaps eliminated. The problem with J.P. Morgan is that they have complicated structured products. They're sometimes difficult to value, yet traders find some way to record an accounting profit on them, and therefore they buy them in large quantities. And the regulators also, do they have enough capacity to help, determine the value of this complicated assets as well? No, you see, that's the problem with banking. They shouldn't really be getting involved with complicated structured products. Shouldn't they? Because if these banks, because the banks obviously know better, because they're the ones who deal with these assets. In theory, they know better. In reality, they don't. There are plenty of instances where banks buy complicated structured products and they don't know how to value them. So they make assumptions, and that pushes up the value. But in answer to your question about regulation, if you constrain banks from using complicated structured products, you can reduce the amount of regulation that's needed. So you end up with effective regulation rather than too much regulation. So banks really need to simplify their operations. it's not a big problem here in Nigeria, but certainly in America and Europe it's a major problem. However, that said, there are problems with simple banks as well that need to be addressed. And one of the problems is that banks are not pricing loans correctly. So for instance, if you come into me for a loan and I offered you, somebody had offered you 5%, I might be tempted to offer you 4.8%. That's known as predatory pricing, and it's quite dangerous because it means we end up undercutting each other, or the banks undercut each other, and therefore they end up expanding too quickly with dodgy loans. So loans, you need to assess the risk properly and price them correctly, but the pricing of loans has been the major problem with Basel II. It hasn't been implemented correctly because banks have lent quite recklessly.
Well, Pascal, this is for you. If you were going to say something?
Yes, I was going to say that, my problem with regulation, my concern with regulation, rather my view on regulation is that it is good. It's good, but that is not the major reason for banking. Banking is a business. I think there must be a time that the regulation must be, the infrastructure must be put in place, and then the people must be allowed to play the business of banking. If not, they're going to retract and begin to do risk management as it's not a business model. Risk management is to manage. It looks like
it has become that now. That's where my question was going. Risk management, what those two major things the central bank here has been preaching, risk management or measurement, good corporate governance. That has been, the main. And that's what the banks have been doing. And that's why, they're not lending to the real sector as they should. They're afraid. They're just relying on the cost of transactions, buying treasury bills,
if that's all you take away from what I have to say is this, that'll be okay. The regulator must play his role as a regulator. There's nothing wrong in trying to ensure it's public funds, and it's a peculiar business where it's only business that you say 8% of shareholders' money is all you require, and 92% is depositors' money. You can do business with it. So there's absolute need for regulation. But you must not forget that the moment you let the banks retreat and begin to plug holes, and risk management comes as a result of the gaps that are opened up as you do business. Banking is a business, and you do business by lending. The moment you don't lend, a time will come over time when you will go bust. It's just a matter of time. So if you don't let this guy become risk management experts, they are also business people, and this affects the economy. The moment the SMEs are not getting the loans, the moment you don't allow them to you remember when Soludo was around and he was a business development person. Sanusi has come in as a risk management person. And that's what we've been saying. That's what we've been saying playing out, Jeff. They're not exactly lending to the SMEs. A management, a coalition of forces, and an aggregation of all these arms of regulation, but at the same time give them an allowance for the banks to now begin to do business. Listen, I give an instance. Access Bank and Intercontinental Bank merger has brought Access Bank to the fourth largest bank in Nigeria by branch size.
Yeah, so that happened because they teamed up, they bought Intercontinental, which was known to be a retail bank.
That's what I'm saying. And their balance sheet will have increased. Everything about Access Bank will have increased now. And their job will be to sweat those assets. If they retreat back and begin to manage risks, only risks, over time you have a challenge. My point here is that the banks need to recalibrate so that they can re-engage the market.
Are you talking about their banking, the business model?
The banks need to, what Access Bank used to do before now cannot be the same thing that will work after consolidation. It has changed. The game has changed, and I'm sure the MD is aware of that. He said that if they're going to play strong in retail, what are you going to do with all the branches you have? If you didn't plan to be a retail bank. So I believe very strongly that I'm sure he has a model he wanted to pursue, but I'm saying that they must be given the allowance to play as a banking business, while regulators will have the skill sets to be able to monitor their excesses in terms of risk management infrastructure.
Now, Pascal, we're almost completely out of time. Now, let me ask you. We don't know exactly when this stress test will occur for Nigerian banks by the CBN, but I understand you're training them right now. What are expectations? What do you think they will find? Well, I want to believe that the banks have been good corporate governance and proper risk management and all of that. But are you optimistic that it would all go well? It
should go well. It should go well. But my concern is that
better go well.
Yes, it has to go well. But of course, you may begin to see one or two. You still see one or two lapses here and there. That's what they're regulated. That's what they pay. That's what they're there. But I keep saying here, the point I keep making here is that Soludo said it in the capital market probe. He said if you are going to permanently ask why a market is failing, then you become permanent. Because the market will go up and go down because of the nature of the business. People are going to stretch themselves.
Perhaps the nature of the human, you know, the human nature, character, the greed and all of that. So are you looking at the Nigerian banking model, all that you've seen since you came into the country training, are you satisfied with, you know, how the banks are, how they're running the business and the regulators?
Well, it's certainly improving, and the regulators' knowledge is certainly improving, and they are focusing on some of the important issues they have learned from what has happened in Europe and America. I suppose the one thing that they will find is that the profits of banks are overstated and the losses are understated, and they will come across some very poor quality loans which haven't featured yet in the annual report. So I suppose you can expect a little bit of bad news on the banks, but hopefully not too much.
Well, but bad news we can handle. Thank you, gentlemen, for being here. I'm afraid we have to leave it there for now. Thank you so much for your contribution. Very insightful contributions. Thank you so much. I have been talking to Cormac Butler. He's a consultant director, Jeff and O'Brien Training International, and Pascal Odibo, the group country director also of Jeff and O'Brien Training International. We've been looking at Nigeria's banking sector with particular focus on stress testing. The Central Bank of Nigeria very soon will conduct a stress test on Nigeria's commercial banks to see how strong, how sound these banks are. But that's what we've looked at today, and that's also a wrap on today's edition of Business Morning. Thank you so much for being a part of it. Channels News Track is at 11. I'm Esther Obudaga. Bye for now.